Okay, it's not live yet.
Yeah, it says it's live.
This is redirecting. Okay, now it is.
Hi, my name is Alicia All, and I'm with Credit Score Pro, and I'm here with Ivory Becker, who is a co-founder of Credit Score Pro, and we're coming live to you today to give you a webinar on why most credit repair advice is wrong. Are you ready, Ivory?
I am ready. Let me go ahead and I will pull up everything for today. Screen share.
And Ivory, this might be one of my favorite subjects to talk about. I get really heated on this one, right?
We better be prepared for you then. Okay, here we go. Let me know when you can see my screen.
I can see that.
Okay. There's a little delay, so bear with me.
Sure.
There we go. Well, why don't you start by introducing yourself, and then
Okay,
we'll go ahead and jump into everything.
sure. So I'm Alicia All. I'm co-founder of Credit Score Pro with Ivy Becker. I have 20 years experience in the credit world, lending, real estate, credit repair. And today we want to bring you some information on some advice to give you, well, no, some advice not to take. That most credit repair advice is being given out. And Ivory, would you like to introduce yourself?
Yeah, so my name is Ivory Becker, also co-founder of Credit Score Pro. My background is in regulatory compliance when it comes to default and the credit space, as well as working in lending, working in obviously credit repair as well. Really anything that has to do with negative accounts, I've probably worked in that area. We do these lives every single Thursday, so feel free to join us next week as well. And every week we have a different topic. When you register, you do have the option as well to submit questions ahead of time. And then you also have the option during these live events to ask questions in the chat. And we'll make sure we're answering your questions that you've pre-submitted and your questions during the chat throughout today's live as well. And it also gives us great ideas on what we can do in the following week's live if it's not part of the topic for this week.
Perfect. And let me say thank you everyone who is here today. We're so excited to bring this content to you. Ivory, your display settings are showing like part of the display and then part of the next slide. Is there a way to just have the one slide?
It should be showing, it's showing your presenter view then. Hold
Yeah.
on, let's
So,
just, it doesn't show that I'm sharing. Try this one.
okay.
What's that one look like?
That's the one. That's the one I
Oh,
want.
that's weird. They both showed the same when whatever, it's fine.
I figured your screen showed something different. So thank you for that. All right. So they've already met us. Let's move on.
There we go. All right, so let's start by talking about why this event matters. So what we want to talk about today is really challenging what you know about credit and exploring some of those misconceptions or those common knowledge items that may actually be incorrect. We also wanted to dive into the real factors that impact your credit score, as well as help you to learn how to manage your credit more effectively. And the reason why is because we do want to debunk the widespread credit myths. With social media, we see so much misinformation that's spread, and we want to make sure you're getting the actual facts. And that leads us to wanting to provide you that accurate and actionable credit advice, and then empowering you to make better financial decisions. All right, so let's start with everyone's favorite topic, and that's credit repair. So the limitations of credit repair companies in providing comprehensive advice. Ali, I'll let you go ahead and dive into this one because I know you're pretty passionate about this topic.
I am very passionate about this topic. So the problem with traditional credit repair companies and providers is number one, there could be high cost to it. And that's one of the reasons that Ivory and I came together and co-founded Credit Score Pro is because our thought is to make this accessible to everybody. So that's one of the issues that we have with the traditional credit repair. Lack of transparency and communication within the process that they look at. Number three, they look at one size fits all type approach. So they just kind of they have a system of how they do things and they just do it based on that system rather than customizing it for the individual. Issue number four, it's a time-consuming process. So any of you have gone through credit repair process, maybe in the process for several months, and sometimes not getting a lot of feedback in those months. Issue number five, dependency. You're dependent upon the credit repair company to do their job. You're not able to have proactive actions that you can take for yourself. Number six, misleading or unrealistic promises. We've all heard them, and we talk about this all the time in terms of credit repair companies saying, you might hear stuff like, I guarantee 100 points in 60 days, things like that. And then you find that they cannot produce those results. And then issue number seven, impact on credit education. One of the primary things I think that lacks in traditional credit repair is a lack of education. But fundamentally, like, what do we do to improve our credit score? How do we keep good credit? What do we do wrong? So they're trying to fix damage without educating on what you can do in the future and what you can continue to do right now to improve your credit.
Or to prevent these situations from happening again. I think sometimes we see people going back to that credit repair model over and over again. And ideally, we want to eliminate that cycle of in and out doing the credit repair process.
Agree.
So many credit repair companies do excel at removing negative information from the credit report, but lack the broader understanding of how credit itself functions and how credit works. What this really means is that a credit repair company that's in that traditional model may know how to get things deleted from your credit report based on the laws around credit reporting. But what they may not know is how your credit score is calculated and how to properly advise you on improving your score outside of just removing negative information. Because negative information is only half the battle, and sometimes even less than that. Sometimes what we see is you may have everything deleted from your report, and in some cases now have no credit score, or your score may still be lower, let's say in the sixes, and you want to be in the 700s. You want to get that to that perfect credit score, but are missing the steps in how to achieve that. So, yeah. Anything you want to add to that at all?
No, I just got someone in chat mentioned about having a bankruptcy and going through credit repair, and the credit repair organization was able to remove the negative things off of their credit, but did not advise them that they needed to rebuild credit. So they went through that process and it took a long time. And then when they went back to go get a home loan, which was their primary goal in the first place, they did not have any credit open and active. So they were not able to get qualified. And they felt like that they spent that time with the credit repair company and they didn't advise them on that important part of the process.
Sure. I think that brings up a good point. As you're removing negative information, you want to be reestablishing or rebuilding credit that can cause your credit score to improve even faster than it would otherwise. So it can shorten that journey to getting to that credit score goal or helping you qualify for a new home or whatever that next financial step is for you. So let's transition and talk about some common misconceptions in credit in general. We discussed credit repair and how they don't have that focus on the algorithm and how credit works in most cases. So let's dive deeper into that. So we're going to just go over what the common myths are, and we're going to explore these myths in more detail later. So myth number one, checking your credit score frequently damages it. Myth number two, carrying balances on credit cards improves your credit score. Myth number three, closing old credit accounts boosts your credit history. Myth number four, your income influences your credit score. And myth number five, paying off negative records or negative accounts removes them from your credit report immediately. Now, where do these myths come from, Allie?
They come from everywhere, but social media is a big one, right? We hear a lot of things on social media, and I think they're all like gimmicks to pull you in to, use the credit repair service or whatever they might be selling. So I think there's a lot of that going out there. And unfortunately, it's a battle that me and Ivory are trying to fight, but it's a hard one because people do go to social media to get their information. It's easy, it's accessible. And unfortunately, a lot of that information is wrong. So I think we get a lot of myths from there. I've heard the myths come from banks that will say, get this credit card with us, max it out and make your monthly payment. So, I mean, myths are spread by a lot of people who, and I think some of it's not like that they're trying to tell you something wrong to hurt you, but in that
Right.
they really think it's true because sometimes it sounds like common sense, right? And credit doesn't always fall in the common sense category.
Right, that's so true. And there's such a lack of financial literacy and financial education within our country. We're not taught in school. Even those in banking, or in mortgage lending, or any profession where you're in a position where you're helping consumers borrow, it's very, very rare that there's training on credit scoring and how that credit scoring algorithm functions. And some information that is out there may also be outdated or based on older credit score models. Over time, the way your credit is calculated changes as new models are introduced. So,
Mhm.
and then of course, we have the anecdotal experiences, right? We, as humans, have some biases and some fallacies, right? We tend to apply a result. We apply conclusions to certain actions that don't actually correlate with one another, and that happens a lot in the credit space. And we'll talk a little bit about that with some of the examples we'll see here in a bit. So let's take a look at these examples. We have the frequent credit checker. Emily frequently checked her credit score, fearing that it would drop. Contrary to the myth, her vigilance didn't harm her score, but kept her well informed. Now, why is that, Allie?
So when we're looking at our personal credit reports, it is a soft pull inquiry, which does not negatively affect the credit score. And I think a lot of people don't understand that. They don't understand how the credit scoring system works, but
Mm-hmm.
you're not applying for credit. And that goes the same for like if you go call, your utility bills and you're getting new utilities in your name, and they're going to pull
Mm-hmm.
your credit to see if you call, if you're going to pay a deposit or not. Those also do not affect your credit score. So there's a lot of credit pools that don't. And I think there's a lot of misconceptions about what actually does hurt your credit.
So next we have the balance carrier. So Tom believed that carrying a balance on his credit card would boost his credit scores. This myth led him to unnecessary interest charges and payments without really improving his credit. Now I know we could talk quite a bit about this myth, but Allie, give me a couple of good points for our live audience to know about this myth.
Okay, so number one, it's a myth that is carried on for a long time, and
Mm-hmm.
loan officers are a big culprit of this myth. I hear them all this time say stuff like, you need to have a balance on this credit card, don't pay it off, that'll improve your score. So that's, I think, a lot of lenders just have this thing in their head that that's how it works, and it doesn't. And then, like I said earlier about bankers talking about, get this credit card maxed out and pay monthly payments on it. That's going to show you can pay your payments, and it, helps your credit score. And that also is not true. So it's definitely a widespread myth. I
Mm-hmm.
think it's carried on for many years. So it's almost believed as true. And if you say contrary to that, you might think you're lying, right? Hmm.
Now, now this next one's one of my personal favorites, the account closer. Sarah closed her oldest card to tidy up her finances. Maybe she was getting ready for a home purchase, and she didn't realize it would shorten her credit history and lower her score. Allie, in your past as a mortgage lender or a loan officer, excuse me, did you see this happen from time to time with consumers?
Oh my goodness. So remember when Dave Ramsey came out and he was like really big and everyone
Yes.
was following Dave Ramsey? This is where it really started to spawn where people were closing their credit cards, not just their oldest, but all of them. They would pay them off and, they're trying to tidy up their finances, get out of the debt, and then they would close their credit cards. And then they'd go try to apply for a home loan, and we can't give them a loan because we don't have any credit history, right? This is a big problem many years ago, and I think it's still a problem. Just today, I had a client that I was talking to. We were going down her credit report. She goes, I don't think it's that bad. She was in 500s, low 500s, I think a couple in the 400s. And she goes, I don't think it's that bad. I said, no, it's not necessarily that bad, but why are you getting a credit card, paying it off, and closing it? And so we had this long discussion about that, and she didn't know. She simply didn't know that
Mm-hmm.
that was part of the credit algorithm to produce those higher scores. So it's again that lack of education.
Mm-hmm. Yeah. Yeah. So you want to keep your accounts open for a long period of time. Rule of thumb, don't close your credit cards if you don't need to. We're not recommending that you keep a credit card that has excessive fees, high annual what's it called? High annual fees.
Annual fees, monthly fees,
What am I? Oh, I know some
first
cards
premier.
that have, that's what I was just going to go into, that has processing fees each month for statements, right? Like you don't need to keep bad cards. But if you don't have a card that we would classify as bad or excessive with the fees, then keep it open. That's the rule of thumb. Okay, moving on. All right, the truth behind credit score. So we've talked about the myths, so let's talk about the truth. So fact number one, a credit score is a numerical representation of your creditworthiness. Now, just to put it plainly and to make it easier to understand, really, it's just a risk assessment tool. The higher that credit score, the less risk it is for you to borrow money from any sort of lender, whether that's a credit card company or a mortgage, an auto loan, any type of lending option. If you have a lower credit score, it means you've made some payment hiccups in the past, and the lower that score, the more hiccups you've experienced. Meaning it's more risk for a lender to let you borrow funds. This is why they have higher interest rates, more fees associated with them. They essentially want to protect that ability for them to let you borrow funds in the event that you don't pay them back. Number two, scores are calculated using data from your credit report. Okay, so we get that. But what is that data? So, what's really important to know is the amount of information on your credit report is really limited to your payment history. It's not looking at your income, it's not looking at anything as far as your age, your demographic, who you are. It's really just looking at what are my open accounts? How am I paying them now? How did I pay accounts that were closed in the past? If they were negative accounts, they're still going to factor into your score. If you had good payment history and it's closed, it's no longer going to factor in your score. And the whole idea is it's a predictability. Based on my behavior right now, how predictable is my future behavior? And this is why if you don't use things like a credit card for 3 to 6 months, it's no longer calculated into your credit score. It removes that predictability because they don't know what your behaviors are right now. Number three, lenders use credit scores to evaluate the risk of lending to you. We talked a bit about that. The entire point of a credit score is it's your report card. It says to lenders, if you have all A pluses, hey, this is a good student. They've got their finances in order. And it's not a lot of risk for them to borrow, and they roll out the red carpet, as Allie likes to say when you walk in the door. Number four, scores fluctuate based on your credit activities and financial behavior. We talked about this a little bit. So if you're not using your credit, you may see your score fluctuate in that either you have no credit score at all, or maybe it takes a dip because you're no longer having things like your open credit cards calculated into your score. Or maybe you no longer have any payment history associated with loans anymore because they've aged off your report. If you're using your credit cards more excessively and carrying higher balances, you're going to see your scores dip. And when you pay those cards off and those balances are now zero or even lower, you're going to see your scores rise. So it's a moving number. I mean, it's essentially a moving and flowing target that is used to measure your financial health. And number five, there are multiple scoring models, but FICO and Vantage scores are the most common. We're going to really only touch the surface of this because we talk about this in other lives. There are different types of credit scores. You have the FICO credit score, which is used in 90% of lending decisions. And then you have what's known as the Vantage credit score, which was created in 2006. It's a more recent score model. This credit score is what you see on resources like Credit Karma, for example. And this is often why the score you're seeing on Credit Karma is different than what your lender sees. That lender is pulling the FICO credit score. Allie, is there anything else you wanted to touch on this side of things?
No, we have a chat question that said they were wondering why their scores were different when they went to try to buy a home versus what they saw on Credit Karma. So I think you answered that question. Do you want to give a little bit more detail for that person?
Sure, absolutely. So even in mortgage lending or credit card lending or auto lending, there may also be a variance in the scores that they use. I'd mentioned a little bit earlier about there being different models. So over time, since credit scores were introduced, they've made tweaks and minor changes to the credit score algorithm based on changes in consumer behavior. Lenders can choose to use different credit score algorithms based on what they want, based on what they think is going to be the most accurate representation of the consumer they're targeting. In lending, they've used the same credit score algorithm for forever. It just hasn't changed. So they're using one of the oldest models. So it's in mortgage lending, excuse me. So it's very common in mortgage lending to see a different score than what you would see in any other type of application for debt, even if those other applications are also with a FICO score.
Yeah, and to simplify that, to answer that question, I would just say that the mortgage credit scoring algorithm is mean. So it takes a harder weight towards those negative items on your credit report. So you're going to see a
Yeah,
lower score with that model.
absolutely. So let's look at those score factors. Allie, do you want to dive into some of these score factors for our attendees today?
Yeah, so you have 5 different primary score factors that you need to consider when you're working on your credit. So the first one with the most weight is your payment history, which is represents 35% of your score. So this is really important. This is paying your bills on time, right? So I often tell people, like, if you have a credit card bill or a utility bill and one is going to go late, pay the credit card, and as long as your utilities didn't get off, pay the utility later because they're not going to report to the credit report. So, so factoring that in, knowing that whatever's on your credit report should be a primary focus for you because it does have a 35% weight of your credit score. Um, then we have credit utilization, and that is 30% of your score. This is where a lot of people can really impact their credit score to the better and to the worse very fast by having credit card utilizations either low or high. So if you have a number of credit cards and the utilization is over 10%, right, you're going to start to see a tick of difference in your credit score. So
Mhm.
the ideal would be if you can have your balance at or under, my recommendation would be 20%, then you're going to see an improvement to your credit score pretty fast. And the opposite way is true too. As it's a holiday season, people are maxing out their credit cards. If you're maxing them out and you wonder why your score was a 600 and it just dropped to a 500, that might be the answer, right? If nothing else has changed. It's a
Mhm.
very heavy weight to your score. Then we have 10% for new credit. This would be new credit inquiries that you have, things that you've opened recently. That's going to factor in. So you do need to be careful about just getting credit cards because you're now shopping for the holidays and they're going to give you 10% off because
Right.
that does have a factor in your credit score. And I've seen people, unfortunately, go to the mall and go to every store and get the 10% off for their credit card purchases. And they'll say stuff to me like, well, I did it because my score's low anyway, so who cares? And I knew I was going to get denied, but they're still continuously hammering their credit score. That's 10% of it. Type of credit used is 10%. So this would be, do you have different types of credit that you're paying, revolving accounts, installment accounts? Can you pay those on time? And then the last one, which I should have went into the other order, is
That's
15%
okay.
length of credit history. And this is where Ivory was really harping on, don't close those credit card accounts, keep them open. Or my favorite, people will say, well, I'm going to pay off my car loan because it'll improve my score. It won't, right? We're looking at your credit history and how long you've had credit history. When we close things, we lose that, and that can lower the score.
Absolutely. All right, let's debunk some popular credit myths. So, Allie, checking your own credit score is educational and does not affect your score. You had mentioned that before. And regularly monitoring your credit score actually is beneficial for your financial health. What do you recommend for our viewers for monitoring and maintaining their credit scores?
Credit
Softball.
Score Pro. That's simple, right?
Yeah.
Credit Score Pro is it gives you everything that you need, and it has the credit monitoring. So we use Smart Credit as our partner for Credit Score Pro. So with Smart Credit, you get access to Credit Score Pro's dispute function, education, tailored action plans. And then of course you get the credit monitoring that you need. And that by itself has a lot. So definitely get on Credit Score Pro.
And myth number two that we had mentioned, carrying a balance boosts your score. So carrying a balance means accruing unnecessary interest, okay? There is no reason to accrue interest on your credit cards. We know right now interest rates are insane. We're seeing 26%, 29% interest rates. The good rates right now are in the high teens right now. So interest rates are just astronomical on credit cards. It does not make any sense to carry a balance. Paying your balance in full each month is beneficial for your score. There's going to be some new credit score models introduced that are going to start to be used in the future, and this is going to become even more important with those new models. So build those habits now so you don't have to build them later. As you pay your cards down, you will see improvement to your scores. We always recommend focus on one card at a time. And again, you can beat that battle of paying down your cards. If you're in that cycle of having a ton of high interest credit card debt, you can get out of it. It just takes a strategy. And we recommend that snowball strategy.
So
Okay, go ahead.
say that their loan officer told them to put a balance on their credit card and that it actually did help improve their score.
Mm-hmm.
So I think that was like challenging you on that. So do you
I
want
can
to
talk
answer
about
that or
that.
do you want to talk about that?
Absolutely.
Okay.
Absolutely. Okay. So there's a couple of reasons why this could be helpful. One, there was no activity on the card for the last 3 months or 6 months, so it became stale. The credit score algorithm, as I had mentioned before, wants to see that you've used the card. So if it hasn't been used, it can't be calculated into your credit score. So you might have just lost all that beneficial history you have from that account, and that ratio for utilization if it's not being factored into the credit score algorithm for you. There is a very nominal boost you may get from using the card to having 1% on there, but it may be a point, maybe a couple points. So I think that's where a lot of this myth comes from. But it's what's 1 point? It's kind of like the opposite argument of inquiries. Anyway, so that's really all I'll go into when it comes to that
Yeah.
question.
Yeah, definitely. It's that you've had activity that created
Mm,
that where you may not have had activity for sure. Certainly you don't need to keep the balance on it. So I hope that
no.
answers that question. I do not keep balances on my credit cards. I pay them off each month, and that
Mm-mm.
should be a habit for everybody. And
Yeah.
I have really high credit scores, so I do walk the talk, and I
Yes.
do not keep balances ever.
Yes, you definitely don't want to keep balances, but you have to use the cards. You don't want them to go stale. You don't want that creditor to close the cards on you either. Right? If you don't use it, they're also going to close it on you. That's just going to hurt your score even more. So, okay. Number three. Oh, we led right into it. Closing old accounts improves credit history. We talked about this already, so I'm really not going to harp on it too much. But the longer the history, the more beneficial for your credit scores. I know we've both seen so many times people getting ready for a home purchase, closing everything because they're concerned about showing too much debt as compared to their income. If that is an issue, then we would recommend paying off whatever that is that your loan officer is requiring as part of the closing of the loan. That way, you're not going to negatively impact your credit score at the time of trying to qualify for something, but you can still meet the criteria for your loan officer. Anything you want to add there?
No, that was great.
Okay. Number four, your income affects your credit score. Um, I've heard this a lot of concerns around this. Well, if I just had a higher paying job, my credit score would be higher. I wonder, I don't know. I wonder if some of this comes from when credit card companies annually are requesting you to update your income um, on your online platform for that credit card. And maybe some people are assuming it factors into the credit score, or maybe because you can see your employer on your credit report, but your income itself, it's not part of your credit score at all. Not a factor. So anything you want to add there?
Yeah, I think you're right on that the myth probably came because credit card companies, the application asks for what your income is, things like
Mhm.
that. And really the only reason those questions are there in the first place is that they're trying to figure out what your credit limit's going to be. So I think
Right.
maybe that's where that myth came around is like, oh, if I had a higher credit limit, then I would have a higher credit score. And that's also not true. It's the utilization.
Paying a negative record removes it immediately from my credit report, right, Allie?
Oh my goodness. I hear this like on a daily. This is a daily, a daily thing. No, guys, that's not true. Unless it's medical.
Correct. Medical. You're right. There's one exception.
And that's just happened in the recent 2 years. So
Mhm.
before that, that was not true with anything, but it is for medical. We do have some collection companies that you may owe money to that have kind of their own internal system where they will remove it if it's paid. So we do have some of that, and more of that in the last 2 years than we've had in the
Mhm.
past. I remember, I've been doing this for 20 years, so there was time that was not a thing. You were
Right.
not going to get it off. But more and more of them do have an internal thing, but that should not be something you should count on because that's rarely the actual case.
Right. And I do want to point out as well, be very careful when you're having those conversations. If a debt collector or a creditor is saying they're going to update it to paid, that does not mean they're removing negative history from the report. That simply means they're saying you no longer owe them money. So that negative history, whether that's past due payments or the collection itself, would still then remain on the credit report and still have the exact same impact on your credit score. So, all right, some best practices when it comes to credit management. I'll let you take this one.
Okay. Strategy number one, regularly monitor your credit. Get on Credit Score Pro. Strategy number two, pay your bills on time. Can't tell you enough about this. Obviously, that was 35% of your credit score. Strategy number three, maintain low utilization ratios. Primarily, we're talking about credit cards, right? For the
Mhm.
utilization ratios. And that is 35% of your score.
30.
Oh, I'm sorry, 30. Sorry, thank you. 35 on your payment history, 30 on your utilization. Strategy number four, diversify your credit types. So remember that was part of our strategy, or it's part of how your score is calculated. Strategy number five, limit new credit inquiries. We talked about that. Don't get them if you don't need them. And strategy number six, review credit for errors. And what can
So,
you use, Ivory, to review your credit for errors? I don't want to read a credit report. Do you?
no, no. Has anyone ever heard of how big an actual credit report is on the back end? I know, Ali, you have. A single
Yes.
10-page credit report can be about 500 pages raw data. So when it comes to reading a credit report effectively, let the computer do it for you. And so
Yeah.
Credit Score Pro has AI that will read your credit report, identify those errors so you can take action. And that's one of the tips for healthy credit management is to regularly review that credit report for errors. Build long credit history, find the right types of accounts that you want to keep open for a long period of time, right? Those right credit cards specifically. And avoid maxing out those credit cards. You do want to make sure that you learn budgeting, right? It's very easy if you don't have a budget. It's not fun to come up with a budget and maintain it and all of that, but it's very easy to find yourself in trouble and overusing credit cards if you don't have a budget. You do want to make sure you know exactly what's coming in and what's going out, and then creating some control around that. And number four, consider automatic payments. You would not believe how much money is lost on an annual basis for a lot of consumers just from excessive interest and excessive late payment fees. Those late payment fees, 30, 40, $50, they add up to a lot, especially if you're someone who's repeatedly being charged late payment fees. And then be strategic about opening and closing accounts. Not even just, I'm going to deviate here a little bit. Don't just be strategic about opening and closing debt accounts. Think about your banking accounts. You can organize your banking and accounts in a manner that allows you to budget more effectively. And we won't talk too much about this, but by being strategic with your entire approach to money management, you're going to be able to save more. You're going to be able to manage your credit more effectively. And then you're going to reach your financial goals more consistently and more efficiently, excuse me, faster, whatever.
We have a question in the chat.
Yeah.
This person said that she had a bankruptcy and it was
Mm-hmm.
looks like it was most likely due to credit card debt. So she's
Mm-hmm.
really scared about getting a credit card and wanted to know, is it okay not to have credit cards, or is there something she can do to help her from having this problem again?
Sure. So to have the strongest credit score, you do need to have an open credit card. Now, I do recommend in those situations if you are just like, look, I am not open to a traditional credit card right now. There are tools, and we do have them on our website at creditscorepro.ai that allow you to have a debit card that reports on your credit like a credit card. It's a really good way to begin to build the habits to where you start to feel secure and safe again. And then you can transition to a traditional credit card later when you feel like you have those habits built up more effectively. So, yes, you do need a credit card, but you can take baby steps, right, to get to that eventual goal of having a credit card again that you can manage effectively and feel safe and secure using it, not letting it go stale, and then no longer helping your score. So,
Yeah. And if I were to add to that, I would say what I give advice to my clients for, because I
mhm,
have a lot of clients actually who have that same concern that you have. Um, I have them get a credit card and then, put something on it like Netflix, which is a reoccurring bill,
mhm,
and then set your bank account to pay that off and then put the card away and forget about it. You don't need to carry a card. You don't need to swipe it. You
right.
need activity on it, but it can be something that you're already spending money on, and then you just put it on there and automate it. So,
Mhm.
yeah, that's what I would recommend. So I have people who will take them and they put them in the freezer or cut them up, but they have them set on auto payments and auto reoccurring charge.
Yeah, exactly. Okay. So let's talk a little bit more about Credit Score Pro. We've teased at it a little bit,
Credit
but
Score Pro.
yes. So I have written on here a new approach. So Credit Score Pro really is taking over and revolutionizing credit management as well as credit repair, credit restoration. So Allie, why don't you talk to us a little bit about what Credit Score Pro is and how it functions?
Okay, so we talked a little bit about Credit Score Pro, partners with Smart Credit to read the credit report. And what it's doing is it's reading that raw data credit report and it's looking for, like if you're in the disputes function of it, it's looking for errors on that credit report. It actually decides what it knows what's negative, so you don't have to read that. So it's going to list out what's negative. It's also going to decide what the dispute reason is that's best to get that off the credit report. So it's using that AI. It's really learning how the credit bureaus work and what's best to get a negative item off the credit report. So again, nothing that you have to think about, that's doing it for you. And then inside of Credit Score Pro, and I don't know if that's on another slide, so maybe I'm
Keep
going
going.
ahead of myself. Okay. Coaching, there's coaching, credit coaching in there where every video you could possibly think of on coaching of credit is going to be in that part of the portal. We also do tailored action plans. So
Mm-hmm.
you can pick a goal and our system will read the credit report, analyze it, and based on your goal, pick action steps that you should do to improve your credit score. So it's just very
So,
powerful. It's all in this user-friendly interface.
so Allie, is it covering a lot of the topics we discussed today when it comes to that action plan?
Yes, and so much more. Like, yeah, it's really everything that you can think of is included in that coaching.
So, how can Credit Score Pro help you? So, for those of you watching today, and actually, there's a picture of the action plan that Ali was talking about. Um, so, we wanted to give you an image of what that action plan might look like. And this is only part of it. I couldn't fit the whole thing on the screen. um, so, with the automated dispute letters, it saves you time and simplifies the process. So, the AI is going to read that 500 page or however many page raw data credit file and determine what every error that exists is that you're not going to be able to identify with the human eye. From there, it's going to come up with the best dispute reason with the highest possible success rate. Now, it is able to run thousands of algorithms and figure out what that best dispute item is. And it learns from the prior disputes in the past and prior successes, not just from reading your report, but from reading the thousands of other users of Credit Score Pro. So you no longer have to be the expert, and you no longer have to worry about whether a traditional credit repair company is doing everything they should be doing or trying to string you along. Um, yeah, I think that says it all when it comes to the dispute side. Oh, and the best part is every month when it re-imports your credit report, it comes up with a new dispute tactic, right? So it's going to consistently update, tell you what's been removed from your credit report, and make new disputes based on the changes to your report in the past.
I would add that it's got a very high success rate of getting the negative things
Mhm.
off the credit report. I think that's important because we can dispute all day long on different platforms, or go to a credit repair company and get like little things off or whatever. But this has a really good track record of getting the negative things off the credit report. And I think it's more successful than I would imagine most credit repair companies who are professionals doing it would
Mm-hmm.
be.
Absolutely. Now, the education platform that Ali had mentioned is just part of what we offer. It's broken into several different sections with a ton of different modules, and we're continuing to add on to that. So, as we see changes in the credit industry, we'll continue to add more into that content. And then at the same time, you're able to interact with others on the platform through our Facebook community, as well as attend these different lives. Um, and then we also, I actually, Ali, I'm going to let you talk about a little bit more about the action plan because that's, the next section.
Yeah, so the action plan is one of my favorite parts about it. There's so many things that are great about Credit Score Pro. But one of my
Absolutely.
favorite parts is, and I'd like to use this example, but if you decide you want to lose weight, right? You have this goal, I want to lose weight. And then you're like, wait, how do I do that? What am I supposed to eat? What exercises should I be doing? What's the best, easiest way, fastest way? So we're Google searching all that stuff, right? So Credit Score Pro allows us to create action plans based on that goal, and it's going to
Mhm.
spit out for you a detailed list. And like this image shows on the screen, action steps that you can take. This is above and beyond dispute process. Remember, Ivory talked about how um, doing disputes is like half the battle, right? And it might not even be half the battle, it might be a smaller portion of the battle. But these action plans with tailored action steps for you to take are really the big bulk of how to improve your credit and to create some really good financial habits. And it allows you to understand what's going on with your credit. So when you do an action step and you see the advantage in your credit score and you see you're moving towards that goal, number one, you're going to feel better about what you're doing. But number two, you can see, oh, because I did that, this happened. And you start to learn what your actions that you're taking and how they affect your life. And
Mhm.
this goes in conjunction with obviously the educational platform with all the coaching videos. So you can watch a coaching video, do the action step on the action plan, and see that it actually is true,
Mhm.
right? You'll see the results. It's it can be fun.
And you can keep updating that action plan, right? As they're achieving different goals, right? Or checking off those boxes from their action plan, it's going to continue to refine and update the strategy.
Yes, and actually, that's a great point. So a couple things. Number one is every month you can update your action plan, even if you're keeping the same goal, because then you can see the
Mm.
changes that you had from the month before. And for me, that's really good. It's like checking off things off the list. I see the list go down. I feel good. And I feel more inclined to do the next step, right? So I recommend that you run that report each month to get your new action plan. And then also when you have a change of goal that you
Mm.
select a new goal and run that action plan for that specific goal.
Okay, we have our Q&A, and I know we've answered a lot of questions so far. Has anyone, go ahead and put in the chat if there's a question that you have that we have not covered at this point.
Okay, so I do see one question, which I think you might have answered, Ivory, but I think you might need to restate it. I have one that wants to know, and that's actually a couple of them, want to know like if they were to get started today, what do they need to
Mhm.
do?
Oh, that's a great question. So to get started today, all you have to do is go to creditscorepro.ai. And from there, you're able to click the sign up button. Remember, and actually, I don't think I even mentioned this, Credit Score Pro is free. So the only thing you pay for is the cost of the credit monitoring. So you can access Credit Score Pro's action plan, you can access the dispute software, and the educational course in the coaching section, all for free just by setting up your credit monitoring. And so again, just go to creditscorepro.ai, and from there, you have access and you can get started right away.
Well, you answered one of the other questions was how much. So you already answered
Oh,
that. Thank you. Uh,
oh, I don't think I said it how much. So the cost for the credit monitoring is $39.99.
oh, I thought I heard you say that. Maybe because I already
Maybe
know
I
the
did.
answer to that.
I don't know.
So yeah, Credit Score Pro software is free, like Ivory said, but you would pay for credit monitoring that would use that credit report to read and create the action plans and the disputes and all that fun
Mhm,
stuff. So that's where you have that fee of the $39.99,
mhm.
which is significantly less than traditional credit repair by far.
Yes.
And you get all of the benefits of Credit Score Pro with that credit monitoring fee. So that's great. Any other questions? Feel free to chat and I'll read them off.
Okay. We'll go ahead and we'll move on then. Okay, so what are the key takeaways from today? Really, we want to spread awareness of the limitations and the issues in the traditional credit score model, not for any other reason other than we want to make sure that you get the right help. It's important to be cautious when it comes to finding the right kind of assistance. But also, we wanted you to know that there are options available out there that may be more comprehensive, like Credit Score Pro. Um, we also wanted to dispel a lot of the myths that exist and make sure we're sharing what those facts are. And it's important to make sure you're monitoring your credit, paying things on time, and having smart credit habits. And then obviously, the last thing, Credit Score Pro. We offer a nuanced approach to not only repairing your credit, but managing your credit and building in your financial literacy. So, anything else you want to add, Allie?
No, I love it.
Okay. So stay connected with us. Gain access to Credit Score Pro at creditscorepro.ai. Access our lives and future events through our Facebook or our YouTube. We are putting our lives on Facebook and YouTube too, like so you can watch the recordings later. But you can register early too, so you don't forget about the next events, and then you can see the topics too. And then to explore some additional resources, including articles, guides, our FAQ, as well as a whole bunch of different credit building tools, you can visit creditscorepro.ai, and the Build Credit tab and the Blogs tab are going to be your friends there. And then again, you can join our Facebook community, Credit Score Pro AI Credit Revolution, and you can get support with others that are also going through their credit journey. And feel free to ask any questions you have there. And then we hope to see you again next Thursday.
Yay. Thank you guys for being here. I appreciate it. It's fun.
Okay, I'm going to stop sharing and give me. Okay. I have too many windows open.